Dumb money versus smart money, and why quantum never follows the noise of the crowd. Every day, two fundamentally different capital flows collide in the financial markets. Smart money, strategic, targeted, and long-term oriented. And dumb money, emotional, noisy, and often late to enter or exit the market. What is dumb money? Dumb money is not a derogatory term, but rather a neutral market observation. It refers to the capital of investors who make decisions driven by fear, greed, or media hype. They tend to buy too late, sell in panic, and typically follow the market just after smart money has already positioned itself. What is smart money? Smart money, by contrast, represents the capital of professional market participants, institutional investors, hedge funds, banks, or specialized trading algorithms. This capital operates counter-cyclically, deeply analyzes market data, and acts discreetly. It buys when others exit and sells when the euphoric peak signals a coming shift. Why quantum never trades dumb money? At Quantum Data Analytics, we do not follow the impulsive behavior of dumb money. We don't trade the hype, we analyze it. Our algorithms are designed to identify who is active in the market, not just what is happening. Markets don't move because of price patterns alone. They move because of capital flows. The source of that movement makes all the difference. Quantum analyzes volume structures, liquidity dynamics, momentum anomalies, and divergence signals to determine whether the market is currently driven by dumb money or smart money. We only act when there is a clear balance between the two, when the ratio signals either market stabilization or a meaningful directional shift. In phases dominated by dumb money, our system remains deliberately passive. A short-term hype or panic is not a foundation for a sustainable trading strategy. It's merely the noise of the crowd. How does quantum identify who is in the market? Quantum leverages a range of signals and metrics, including volume clusters and unusual trade activity in key market zones. Diverging patterns between price action and capital inflows. Sudden liquidity surges, not explained by technical structures, order flow behavior compared to historical patterns. Sentiment analysis across social media combined with actual transaction data. Together, these data sources reveal the invisible forces behind market movements, making it possible to distinguish between genuine capital flows and short-term impulsive reactions. Conclusion: quantum never trades dumb money. We act only when the interaction between market forces becomes meaningful. Only when it becomes clear who is moving the market do we consider it a sustainable opportunity. Those who follow the crowd will eventually be consumed by it. Those who understand it rise above it. That is the quantum approach: data-driven, emotionless, and committed to clarity. Quantum Data Analytics, analytical, strategic, innovative. quantday.com